Good morning, everybody. My name is Chad Lupkes. This is Total Growth Investing. This is my live stream for Sunday, July 12th, 2020. I'm broadcasting to my page this time. If you are watching, please let me know by posting a comment and we'll be able to see it. Let's bring up my camera so I can say hello to everybody. I haven't done this for very many of the live streams because I'd rather show off data than a bearded face, but okay, just got out of the shower. Sorry about the hair. All right. For anybody this is the first time, I did a live stream within the Dividend investing group for about 2 months between April and June while I was on furlough from my job. I went live every morning at 9 o'clock or every weekday morning at 9 o'clock, and I would talk about my portfolio, I'd talk about my strategy, I'd talk about my ranking list, which we will get to, and we built quite a community. So it encouraged me, just before I was called back to work, to create a Facebook page, to create a YouTube channel, and to continue the effort to educate people. Not a lot of people on YouTube are focused on the main number one rule that people should have when investing. And that rule is not get rich. That rule is don't lose money. That's the most important thing when you start investing, is you don't want to buy into something that is going to lose you a whole lot of money. I know that because I did. And I don't want to see other people make that mistake. That's a lot of what I was talking about on the live streams, and that's why I'm continuing the YouTube channel by doing reviews, positive reviews on the stocks that are at the top of my ranking list for dividend growth and price growth. And I'm doing live streams about every weekend. I missed last weekend, sorry. But I'm gonna continue to try that and go for a little education to teach people how not to lose money by investing in the right things. I have a guest today. His name is Ben, and he has a channel that I've been watching for a while. He started it about 3 months ago, I think. Let's bring on Ben to talk about his stock investment analysis page. Hello, Ben.
Hey there.
Good to see you.
Thank you for having me.
So you started this about 3 months ago, right?
That's right. The first video was posted on March 22nd, I think.
Okay, so that's about, yeah, it's a month before I started my live streams, because I started my live streams on April 12th, I think.
Yeah. Much like yourself, I had a lot of free time at that point in my life.
What's your focus?
My primary focus is on dividend growth investing. So mostly I'm looking at companies that are growing their dividends over time, but I do also look at total growth as well. I want to make sure that they are also companies that are going to appreciate in capital gains over time at the same time.
Okay. I noticed that you've been posting a lot on electric vehicles. I just finished watching the one that you posted this morning on Rivian. You want to talk about that a little bit?
That's right. So right after I was just talking about dividend growth, obviously not a lot of dividend growth in those companies. None of them pay any dividends. And actually, Rivian's not even a public company yet. The main exciting thing for Rivian is just that I think that in the next few years, it will become public. And I think that when that happens, there is going to be a lot of potential for some pretty amazing growth. There's a lot of electric vehicles right now that are getting a lot of hype. People are really excited about them because it's going to be the wave of the future, essentially. But a lot of them are not as far along as I think investors are valuing them. They're driving up the share price like these are companies that are making tons of money, and yet a lot of them are pre-earnings, and some of them are even pre-revenue, which pre-revenue is a pretty crazy idea, quite frankly. But there are some companies like Rivian that I think are more reasonable. I think they have a lot more behind them that actually seems like good quality company. They already have 2 vehicles which are going onto the market next year, an SUV and the truck. They have a delivery van, which is also going to be available next year. And they have a bunch of huge players who are supporting them. So Amazon already has a 100,000 vehicle order for them. Ford and Amazon are both huge investors in the company. There's Rivian right there. So there's, Cox Automotive is the company that owns like Auto Trader. They own Kelly Blue Book. They own a lot of services that are important for things like transportation and purchasing of vehicles and that sort of thing. They've already invested $1.5 billion in Rivian. So you see a lot of these huge companies that have a lot of power, a lot of influence in the space, like Amazon, for example, and who have a lot of the technology that could benefit Rivian. And they are getting really involved. They're investing billions of dollars. Rivian already has a factory finished. They actually bought an old Mitsubishi factory. I didn't mention that in my video, but that's why they already have a full up and running factory. Is they bought one that was already created for Mitsubishi.
Okay. Yeah, I watched the video, and the amount of investment that has already gone into this company before, I mean, you're talking angel investors, right? You're talking initial capital to get started. And if they had enough initial capital to buy the Mitsubishi plant, outright to get started, that's a huge leg up. I know that Tesla, they have their main one down in California, which they're thinking of moving to Texas. They've got another one building in China that is already producing vehicles. They're starting construction. I think they started construction about 3 months ago in Germany for another one, and they're looking at other locations all around the world. We're talking about the death of the internal combustion engine. I posted something the other day talking about how my portfolio is lacking the energy sector. And I also wanted to bring that up because you did a collaboration with Andrew Brown.
Yes.
Let me bring up that video really quick while you're talking about how that collaboration went and what you talked about.
I think it was a really interesting collaboration. He does a lot of investing as well. He looks at a lot of valuation pretty closely. He also looks at debt. He does a really good job breaking down the different stocks that he analyzes. So we decided to do one together. We did Brookfield Renewable Energy Partner, and it's just as you would imagine from the name, it's a renewable energy company. They focus especially on like wind, solar, hydropower, and they've been growing quite quickly. I mean, they are all over the world. It's a global company, and they've been expanding quite rapidly. Which one negative thing, which is pointed out in the video by both of us, but he I think is even more concerned about than I am. Although I'm also not a fan, is that they have taken on quite a bit of debt. But that debt is funding a lot of this, some acquisitions, but also some of these capital expenditures that they are investing to grow their company. But I think there's a ton of potential there for a company like that, because we are going to be moving more and more away from fossil fuels as time continues.
Yeah, we are. So here's the video, which I will drop in the comments in case anybody wants to go to it later. And here's, I don't know if you can hear yourself on this one, but we could play a couple minutes of it just to talk about the beginnings.
Sure.
Let's see if this works. Can you hear it?
I can't hear anything.
Okay, is audio working? That's a good test.
I mean, I can hear you.
Okay.
I can't hear the video though.
All right, so that doesn't work through StreamYard. Good to know. We won't worry about that.
Yeah.
It was just a test.
And one thing that was interesting is one thing we wanted to do just for fun is we were both going to independently evaluate what we thought fair value, or what a good price to buy in would be at. And we weren't going to tell the other person what we were looking at, what we were thinking about. And I think our end outcome, I think we were about $2 different per share. I think something like $2 or $3 different. There you go. So yeah, $3 different. So it was interesting to see that our estimations of what we would be willing to buy, what we thought was a fair value, was actually pretty closer than I thought it was going to be. So that was kind of interesting to see.
You also gave a shout out to my favorite website.
and your favorite channel, right?
Dividendstocks.cash. The data that Torsten gathers and then compiles is incredible. I give him a shout out every time I use his site. So thanks for that. I did notice in the video that you thought it was an okay investment right now because of the potential that you saw, and he wanted the price lower at 38, I believe. So he didn't think it was a buy. Um, so seeing that difference was interesting, where it's just it, it was a binary yes or no. Would you buy right now? And you said yes, and he said probably not.
I
So that
think
was
that I
interesting.
said not at this price either, though, because my buy price was $41, and last I checked, I think it was like 55 or something like that. What is it at? 45? I can't remember. Hang on. Let me double check. Oh, 40. Right now it's $49. I don't remember what it was at the time that this video was made. I
Okay.
would have wanted it to be lower too. But I think that he was less interested in the company in general just because of some of the issues with debt, as an example. Like the debt is high. If you look at their ability to pay off some of that debt, you're looking at some of the interest coverage, you look at their like the quick ratio, the current ratio. The numbers are not amazing. They're not to the point where I think they're going to go bankrupt or anything like that. But they're certainly not the kind of quality that I usually look for in other companies. So I think that for me, I actually am an investor, but I bought in at I think like $30 maybe per share. So quite a bit lower, better margin of safety. And I think that because of some of those issues, I don't think he would be even interested in investing if it dropped another $10 or so per share.
Interesting. Okay. Well, like we've talked about a couple times, the way that I invest is for the future. I mean, I'm not investing for income today. I'm looking for a way to generate an income and build a large portfolio so that when I retire, I can transition to a healthy income portfolio that will then pay my bills.
Mm-hmm.
So gains of any kind are what I'm looking at, and that's what I saw. And we talked about that when I gave you this. Um, in on Facebook chat, because at the end of 22, the fair value is higher than the current price. So, and I think it's going to go up. And like you said with electric vehicles, we're in a transition phase. You
Mm-hmm.
know, we're moving towards the electric vehicle um, being the standard for personal automobiles and trucks and SUVs and everything else. And one other interesting thing I heard from Andrew in that video is he kept talking about this as an energy company.
Mm-hmm.
And according to the S&P, according to all of the metrics and stuff, they actually don't consider themselves to be an energy company. They're a utility.
Mm-hmm.
I'm seeing a lot of renewable energy companies that are choosing to identify themselves as utilities or technology or something other than the energy sector,
Mm-hmm.
even though everybody knows that they're energy. I
Yeah.
found that really, really interesting.
Do you think that's just a PR move, or is there something more to that classification that benefits them?
I think it feels to me like they are leaving the energy sector for oil, gas, coal, natural gas,
Yeah,
and
fossil
and
fuels.
all of that. And I don't exactly know why, because the core of our civilization, is how much energy we consume. Whether that energy is electricity or calories or whatever,
Mm-hmm.
everything is based on energy, and the efficiency of our civilization to generate and distribute and consume that energy. It's the basis of just about everything if we want to be a civilization.
Mm-hmm.
Um, I would love to see a solar company say, you know what, we are an energy company, put us in there. They would automatically, in all likelihood, especially right now, be the top stock in the entire energy sector. you know,
Yeah. Well, I mean, one thing that was interesting is back in March or April or so, I remember, all the energy companies were getting hit really, really hard. And I was still up like 60% on Brookfield Energy, like the renewable energy company, which was crazy because, everything else, I took a hit. I was down 20% or even 30% on some of these energy companies that I bought that were like these midstream companies, for example, except for Brookfield. And Brookfield, I was still way up. It was pretty crazy to watch. So I think that people are still seeing it as for its future potential. And so even when we have this market crisis,
okay.
you have these problems with energy, with oil, the oil war and all that. Maybe because it's not involved with oil, so the OPEC issues are not as directly related to it. But I think people are still giving it that premium where they value it in a different way than they're valuing some of these fossil fuel energy companies.
Yeah, I agree. All right, you wanted to go over some of the some of the tools that I have built, and my ranking strategy, and you had some questions about how everything worked. You want to let's go into that.
Yeah, yeah, I'm very interested.
So this is a list of the tools, and it's not I don't think it's, no, it is missing something. It's missing something important that I'll add as we go along, and it goes along with the Rivian video that you did. Um, so this is a list of the online infrastructure that I have built for total growth investing. Um, the first thing on the list is a slide presentation. So this is a slide presentation that I started in PowerPoint. Oh my God, so many years ago. Uh, I posted it on my page. I actually did my second live stream going over it, and it was really badly done. But it basically goes through my journey and my strategy and how I came up with it and what it means to me. And I go over some basic words of wisdom for anybody in the market. Like, I don't earn enough. People use that as an excuse. And
Hmm.
it's like, that's what it is. It's an excuse. If you can't think in thousands of dollars per year, think in hundreds, if that's
Yeah,
all you can do. But always pay yourself first. That was one of the major lessons that I got when I left the Navy in 1994, is always pay yourself first, because you're not putting the money away for yourself right then. You're looking at yourself at 65 who might not have anything. That's why you do that.
yeah. And you can get started with such a small amount of money. When Fidelity started doing fractional shares just to test it out, I bought 3 cents of some stock. I don't remember what I bought, but 3 cents worth. So I mean, everybody has just a few cents laying around if they really wanted to invest it, or even a few dollars.
Yep.
So it doesn't even matter how little money you have. Everybody's got at least a tiny amount that they could get started.
I started in June of 2000, and I was about to lose the place I had to live. I was recently divorced, and I was working temp, and I needed to pay child support. And for some reason, I had an extra $45 in my bank account. So at that low point in my life, that's when I started.
Hmm. That's
So
really interesting.
it I wish I had learned the lessons that I had since. I mean, that was 20 years ago now. And,
Hindsight.
hindsight is certainly 2020. Anyway, the presentation goes through all of the other excuses that people give, like, I have plenty of time. No, you don't, because the more you put in early, the faster it's going to grow and the more you're going to have. Only in the investor class wins. If you buy one share, you're in the investor class. Sorry to say. Uh,
Right.
I need to pay off my debts. This one is interesting, and I'd like your take on it. I think that people should invest even if they have debt. I see a lot of comments in discussions on the group saying that if you have any debt at all, you should not be putting any money in. And I'm looking at that going, no, that's not paying yourself first. That's
Yeah.
paying the credit companies first.
That's sort of like
Um,
the Dave Ramsey philosophy. And I think that, if you want to take that philosophy, which Dave Ramsey tends to advocate for, I think it kind of has the assumption that your average person doesn't have the financial knowledge or savvy to navigate investing in debt at the same time, which there are some people who really don't. So I think, there are some people who don't know how to manage finances. They don't have a lot of financial education. And for someone like that, maybe it's better to just focus on debt. But I think that in most cases, having both at the same time is okay. If you have a 20% credit card bill, that's, accruing 20% interest, you should take care of that first, because that 20% is crazy high and your investment is unlikely to outpace it. But if you have, like right now, interest rates are so low. I know lots of people with a 2.7, 2.8, 2.9% mortgage on their house. There is a high likelihood that you can beat that with your investments. So I would say make minimum payments on your mortgage and continue to invest. If you have student loans that are eligible for forgiveness, make the minimum payments, get the student loans forgiven, and continue to invest. So I think it depends on your interest rate. It also depends on what kind of a loan that you have and whether it's forgivable in the future.
Right. And I would say even if somebody has a 20% interest rate on their card, you should pay extra on it to get it paid down faster. But even if it's just $10 a paycheck, put something away for the long term.
I like that. And
Because
I
if
think,
you don't, you won't have it. And the main thing that I'm building here, the main concept that I'm pushing is you get into the habit of putting money away, even in your down points, even in your darkest points. You know, I already talked about my own start. You know, I was at an absolute low point in my life, and that's when I started. So if you've got a 20% interest payment, yes, make your minimum payments. Yes, pay extra to pay it down, but also put a little bit away just to get into the habit. Because as that card goes down and those payments go down, then you can be putting more and more away. And I was in a chat, or it was in a comment thread the other day talking about this, saying if you can't put 10% of your paycheck away, put 5% away. And then as your income goes up, then you start putting 6% and then 7%, and you bump that up to 10% over time as your income and revenue increase, because it's not affecting your lifestyle. It's not affecting your expenses and what you spend on it.
Yeah.
So when you get to the income level where you can put 10% in without it affecting you, then your life goes on like it always does. And you're still putting away.
I think even if the amount you're investing is so small, it's almost just symbolic, you know, like $10 in a month, you know, you're not gonna get rich off of that. But I think the benefit is just the mindset that it's creating
Right.
for you.
Right.
Like you mentioned building a habit, but I think it also really changes the perspective that you have on the world. I think that even if you start investing, maybe you invest in $10 in McDonald's. $10 in McDonald's is 0.000000, you know, 1% of that company. But the next time you see McDonald's, you might think about the fact that you now own that company. You start to see the world a little bit differently.
Yep.
You know, it changes your perspective on, you know, global events. Before people start investing, a lot of people are mostly just thinking about me. You know, pretty much. You don't really think about things in a more macroeconomic level. You know, if energy, you know, if oil prices plummet, the only thing you were thinking of is maybe I'll get a cheaper price of the gas pump. But you're not thinking about how that's going to influence all these companies that you've invested in. Will it benefit them? Will it not benefit them? You know, trying to think more abstractly, thinking about the economy in a larger, in a larger, more broad focus. So it just changes the way that you see our country, the economy, other people, other businesses. I think it's a really useful exercise in general.
Yeah, I mean, one other way to say what you just said is it changes your perspective from a customer. You're not just a customer. You're not just a supplier if you are selling stuff to an oil company or whatever. You're not just a shareholder if you own stock, and you're not just a resident who lives around one of their factories. What you are is a stakeholder. And the stakeholder includes, you know, all of those categories. All your customers, if you are a business, are your stakeholders. Beyond your shareholders, you also have a responsibility to the community, and it's that community view that is really going to change, you know, how people look at the world. We actually have a question. Let's see. Question on trickle investing. What are some low price stocks you would pick as holding positions? Okay. That's Hello, Matthew. Good to see you. If you don't have fractional shares with your broker. Okay, you mentioned 3 cents worth on Fidelity.
Yeah.
From my perspective, getting a low price on a stock is not as important as buying the right stock. If I need to save up money to be able to have enough to buy one share, I will save up that money. An example, I started on ShareBuilder and they got bought by ING, and then ING sold them to Capital One, and Capital One was getting out of the retail investment business back in 2018. And I scrambled to put as much money as I could into the account so that I could get my Tesla share above 1.0. I had started with fractional shares because that was the platform, and I had 0.85 of a share of Tesla. And I scrambled before the deadline to get that above 1.0 so that when Capital One moved everything to E-Trade, I kept that share. Because I knew, like we've started with Rivian, and the electric car market was going to explode. And it was a priority for me to get that one Tesla share over. And when it transferred, the price was, I think, around 330. And what is it right now? It's an insane 1,500 per.
Something like that.
Yeah. So I'm proud of my effort at that point to get that above 1. But I wouldn't have been able to do that if I just focused on the low price stocks, because 300 at the time was not a low price stock. It isn't now. I mean, last I looked at MasterCard, it was 300 something. It's like, so the question is that worth getting into if you don't have access to fractional shares? My answer is yes, because you know that they're going to be growing like crazy over the next 10 years. So you want to capture some of that growth. And if it takes you a little while to bring up your account balance to that 300 to be able to get that share, it's worth it. What do you think?
I would agree. I mean, I can understand wanting to buy shares as often as possible. I think for me, a lower valuation is more important than a lower price. As far as price goes, I mean, if by price that we're talking about that's low, if you mean like $50 or $60 is low, then I think there's actually a few good companies out there that have share prices around that I'd be willing to pay. If we're talking about low, meaning like $5, because sometimes that's what people mean by a low price.
Oh, yeah.
That's not what I don't generally invest in those kinds of companies. But like Realty Income right now is 50 something dollars. I think it's a good company. Prudential, I think is around $60. I think Prudential is a good company. But I wouldn't be buying them because of what the share price is at right now. It just happens that they're around the $50 to $60 mark. And so those are more affordable than some of the higher, share price companies like Amazon right now. Last I checked, Amazon was at almost $3,200 per share. I'm not exactly sure what it's at now. But Amazon's also an amazing company. But if you're trying to buy a single share all at once, 3,200 could take a long time to save up for.
Which makes it worth it to get a Fidelity account to be able to get fractional shares.
That's exactly right. Yeah. If you have access to Fidelity or one of these other companies that offers fractional shares, it's definitely worth it.
It is. Okay. So we do have some more comments, but I wanted to get through that list of resources that I put together because you had some questions about the ranking system and everything. So let's see, not quite up to that one yet, but okay, I'll let people look at the presentation later. This is the ranking system that I was working on a little bit earlier, so the rankings are out of whack. So this is my watch list. I've got 673 stocks that I'm tracking. I track basic information, the dividend growth numbers, the slow computer. There it is. So I'm tracking dividend growth rankings, and these are coming from Seeking Alpha. I had a question pop up in a chat the other day about screens not being available from Seeking Alpha. I have an account, but it's a free level account. And everything that I show from Seeking Alpha should be available to everybody, even just with a free account. They're ramping up the advertising to try to get people to pay for their paid services, and they're probably worth it, but my income stream isn't high enough to be able to justify that yet. Anyway, so I bring in the numbers, and then I calculate the rankings, and then average rank This is an average of these four numbers. And then I do the same thing with price. So these are the price increase numbers over the same time periods, 1, 3, 5, and 10 years, also from Seeking Alpha. And then I rank those numbers against each other, get an average, and then I average everything together along with the payout ratio, if they have it, to give me a final score, a final TGI average rank. And then this is the number that is ranked in the green column to show me what my number one, number two, et cetera, et cetera. I also am filling in the 10-year total return and a couple other numbers as I build my strategy for a healthy income portfolio. I have a deep dive where I go into that explanation in a ridiculous level of detail. And I've gotten some positive feedback on it. What else do I want to show? So, Ben, you were talking about the combined ranking scores. What did you want to ask about that?
Well, I was just trying to see how exactly you combine the different lists in order to come up with a total sort of combined ranking score. Was it just like an average of the other scores, or how was that put together?
Okay, so this one in particular is coming from Bullish. Marcin, what was his last name? I can't remember. I'm sorry. I will find that out and put it in the comments. But he has. Let me see if I can find that. He has a watch list that he has shared. There it is, I think. Yeah, this is it. So this is the watch list that he has put together. And he's a professional. He's in the industry researching all of the different valuation metrics, financials, dividends. And so he has separately a way to calculate all of these and give them a grade. And then he translates that grade into a ranking score and then averages them all together into a total score. So he has a ranking on his list where his number one is TPL, Texas Pacific Land Trust. And what I did is I did a lookup on this sheet to say, given this symbol, pull the ranking score and put that right here. Okay, here's the formula. So this is his sheet, and pull this data number 19. That's because he had to, he's got an extra column for the ranking number way over here. And that's where it's pulling that data. This is the total growth investing ranking that I get. So this is market access. So market access is number 11 on the TGI scores. Okay. So he's got this, and then I do a little bit of work to break out the ones where they only show up on one list. And that's down here where the formula says if there is a score in the TGI column, then show that score. Otherwise, give me a 999. It looks like I've got a little cleanup work because he's been updating the list, so I'll do that offline. No, that's my list because I've been eliminating junk. Okay, I'll fix that off when we're done with the stream. But basically, it takes the ones where both of us have numbers for it, and it brings those to the top. And anything where only one list has a number for it, it'll push that down below this point. So this on row 260 is the end of the combined, and 261 is the beginning of individual rankings.
Okay.
So that's how that works. And then you just sort by data sort. So you're sorting by this green column, and this is the stocks that rank the best on my list and his list combined. So
Okay.
that's how that works. And when I came up with this one, I also put out a post saying if anybody else has a ranked watch list that is on Google Sheets where I can do a VLOOKUP on it, you're welcome to join, because the more people we have ranking stocks, the better the rankings will really mean this is actually a winner.
Right. Makes sense. Get a consensus from different people who are analyzing.
Exactly. So let's see. So that's combined scores. I have a lot of people asking me what score does this stock get on my list? And so I built a little bit of automation for that. This is a way for anybody to come in and you can put in any stock that you want to review, like Tesla, and it will pull the company name after the calculations are done, and the total growth score, the dividend growth score, and the price growth score. So it takes a minute to load because the internets are slow.
That'll happen.
But when it loads, you get a result like this.
Mm-hmm.
So if you have a whole bunch of different stocks, you can paste the entire set and it will show you what the various scores are. If something is NA, it means it's not on my list right now. And that's where we get into the next thing. If you'd like to suggest a stock for me to add, and just a caveat on that, I want everything that goes into my list to beat the S&P, because I want to beat the market. If I don't want to beat the market, I might as well just buy SPY and go call it a day.
Right.
But if you have one that you think I should add, then you can fill out this form. It's really simple. Just what's your email address so I can talk to you about it? What's your name so I can give you credit? What's the stock symbol that you want me to add? And tell me why. And then that gets put into this sheet. And nobody's done it yet. I only launched this like yesterday. But this is going to be the result set of what people put in. And I'm going to, over here, explain why I did not, in case it doesn't meet my categories, or what the TGI scores were, what the score was when I did add it.
Mm-hmm.
So that's the latest thing.
All right, very cool. Sounds
And
like
then links to Facebook and YouTube.
a lot of good tools that can be helpful to people, especially those who are just starting to explore stocks or just starting to get a sense of where to look for stocks or what to look at in the first place.
Right. And it's a collaborative effort,
Mm-hmm.
which is really important.
Yeah, I absolutely think so.
Okay, we've got some more comments and stuff. Let's see. So Matthew, continue the thread, or would you just build up 100 or whatever is needed to grab the next full stock? I think, yeah, we answered that. I think if you really want to grab an opportunity and it's worth it to get fractional shares, Fidelity is free. But they lowered their transaction cost down to 0, and you can create an account for no cost at all. They make their money through whatever else they do with the bigwigs. But for retail investors, everything is free. All right. So here's another good question. What are some good screeners? Like Yahoo Finance, what else is out there that can help people find good stocks? Well, Seeking Alpha is the main place that I go right now, but their screening facility, I really haven't found, or I haven't used very much. What screeners do you use?
I think my two favorite are Finbox and Fast Graphs. For Fast Graphs, though, you do need a subscription, which is kind of expensive. For Finbox, some features are available for free, and some of them are only unlocked with subscription. I'm not sure if you get the full screener with for free on Finbox or not. You at the very least can do like a trial with them for free. And actually, same thing for Fast Graphs. For both of them, you can get like a 2-week trial or something. But they have really good screeners. I'd say that Fidelity, since we're just talking about Fidelity has its own screener if you want to use that. If you want a free screener that doesn't require any sign up, any subscription, or anything else, Finviz, which is Finviz, Finviz has a screener available online that's pretty easy to use. So that would be another one to consider.
All right, let's bring that up. Let's take a look at that.
Yeah.
Actually, do you want to go through how the site works?
Well, if you go to the third tab at the top, it goes Home News Screener. I think does it say screener? I can't. I'm trying to see on the screen. Yeah, that should take you to the screener. And I mean, they have a huge list of stocks, and it's pretty. They have a pretty broad range of variables you can look at. So right now we're looking at the overview. You can see overview is highlighted in light blue. But beside that, you can have valuation, financial, ownership, performance, technical, a lot of different things. And what I have done myself is the next one after technical is custom. So for custom, I've chosen my particular variables that are most important to me, which are a combination of those other areas. So you can just check all the different things that you think are most important for you to screen for, and just let it go. See what comes up. You can put in specific tickers at the top if you want only to look at specific companies, or you can just let the entire market go. And then when you have them all populated down below, you can have them ranked or sorted by any of the variables that you've chosen. So that's pretty useful. Sometimes I'll put in all the valuation metrics and then just see which companies tend to come up the best on those valuation metrics. And then I'll start looking at whether or not they're actually a good quality company, because obviously not all low valuation companies are actually a good quality company.
Right.
Sometimes they're low value for a good reason.
Wow. This number's jumping out at me. 376. 376 pages of 20. That's a lot of stocks.
It's an enormous amount of stocks. And actually, Finbox, like I said, I don't know if you can access it now, but Finbox has a lot of stocks on other foreign exchanges. So their list of stocks is pretty extreme. I think Finviz is mostly just a few countries, a few exchanges, but Finbox has a broader range. So I think most of them in Finviz, for example, are USA. They have
Right.
some from outside, but there's more of a focus on only certain markets or certain exchanges for Finviz.
Okay. But let's see. So another one that I use is one of our favorites. Let me bring it up. So dividendstocks.cash is another community-built site. The programmer's name is Torsten. He's a friend of the show. He's been on he's been on my live streams, and he's got his own YouTube channel that I highlight. He has a dividend screener that he can use, that he can offer. He's adding stocks all the time, but it's not manual data, because he's connecting to it's not fast graphs, but it's one of the major sources. And he explains in his general info, but he has 1,049 stocks. You can, let's see, change column visibility, and I want basic, and I want insert date visible. So insert date, where are you? Oh, okay, column, basic, there. So you can do that, and you can see which ones he's added most recently. So he started in July of 2016. He launched his German site about 3 years ago. He launched the English language version about a year ago. He's adding stocks all the time. These last two he just added Yesterday, looks like. So he's busy. And he also has a ranking list and a filter. So this is one thing that I wanted to show because you were talking about international stocks. This
Mhm.
website is based in Germany, and he has stocks from all over the world. You can filter to any of these companies because this is, the Hong Kong exchange, Luxembourg, Singapore, et cetera, et cetera. It's also not just US stocks. You can specify a region by selecting, let's say, France, Germany, um, Italy, and it'll put them up here. And that way it will only show the companies from those countries.
Mhm.
He also has a sector filter and an industry filter. And the other thing you said ranking. Um, he has a way to rank stocks based on different criteria. He's got two in public, growth and income. So if we want to do dividend growth, um, these are the default settings for that ranking system. And then you can come down here and you can click and say, what are the highest ranked based on those criteria based within the filter that you have, which you
Mhm.
can see right here, France and Great Britain. And then you can look down at the metrics, which you've shown on, we talked about that on the video with Andrew, um, the different metrics, earnings, cash flows and dividends, revenues and margins. This is all data that he gets and
Mhm.
compiles and calculates for, including valuation. So this is one that I really appreciate. Um, let's see. Whoa, their cash value is going crazy.
Which company is this? I'm trying to see on the screen.
That is Ashted Group out of Great Britain.
Never heard of it, but it's making me interested right now.
Yeah, it is.
I'm a little curious about this company.
Their stock price right now is 25.65 pounds, and their fair value at the end of 22 is 172.
That sounds insane.
Yeah, it does. But
Either either there's something wrong with this or something big is about to happen.
well, look at their operating cash. Let me eliminate everything but their operating cash. You can barely see it. Well, you can see it easier on the screen than I can. Um, their cash revenue, their operating cash flow is going crazy.
Yeah, that's pretty
But the
amazing.
other metrics based on earnings per share and adjusted earnings per share are down here. Let me remove that. So they're about at fair value at the end of 22 from these two perspectives. They're going to dip because of COVID and then come back again. But
Hmm.
that operating cash flow, that was
It's
hmm.
pretty extreme.
Anyway, this
Right.
this was one of my favorites.
Yeah.
Um, so Matthew, there's a whole bunch. No, Jerry, there's a whole bunch out there that you can use. Let's see, what's next? I know diversification is important, but what if you don't trust a sector like energy? Okay, well, I don't have energy either, and it's the one sector that is completely missing from my diversification. And we talked about that earlier. I'm not too worried about it. Diversification. Um, how important is that to you, Ben? And how do you maintain diversification of your portfolio?
I think that diversification is important, but only to a point. So research generally shows, for example, that after your first 10 stocks in your portfolio, generally there's very little incremental validity beyond that or incremental benefit to you. I mean, the main benefit of diversification is just to stabilize your portfolio. If you put all your eggs in one basket, if that company goes bankrupt or something happens to it, you lose everything. But after you get to 10 to 20 stocks total, after 20, the benefit is very, very small for any additional stock. And really the biggest majority of that benefit is from the first 10. So I'm not talking about sectors right now, and I'm just talking about stocks. But even just, I mean, there's 11 sectors, and some would argue you don't even need 11 stocks. So just something to think about there. There are some sectors like energy that if you're not comfortable with it, I think investing in it just for the point of investing in it is a bad idea, because you won't be as comfortable with it, won't be as confident in it. You're more likely to sell, I think, when something goes wrong for that sector. So buying a company you don't believe in just because you think you're supposed to doesn't make a lot of sense to me. I have almost nothing invested in materials, the materials sector, for example, and I don't plan on adding anything to it. I don't really want to invest in the materials sector. I don't think there's anything wrong with it. I have almost nothing in industrials right now, although I actually do want to get some investments in the industrial sector. It's just that there hasn't been a lot of great opportunities for me currently.
Okay. Yeah, I agree. Diversification is important to a point, but what I'm looking at is I don't want to sacrifice growth. I don't want to sacrifice my portfolio value just to have a stock in one of the sectors. I did, when I go through my list to see what I can buy when I have capital available to buy a stock, I follow two rules. One, I don't want more than 5% of my portfolio in any individual stock. So if I look at my portfolio and a stock is more than 5% of that portfolio, I won't buy any more. And I also do the same thing with sectors with a slightly different number. If I have more than 10% of my portfolio in a particular sector, I won't buy more. I'll move on to another sector. But even that doesn't exactly work, because if you look at the ranking, where's my list? There it is. So if you look at the rankings, um, I have a lot of information technology at the very top of this list, which will show up as soon as my computer, there it is. So information technology is pretty heavy in the top rankings. And I believe that I have like 19%, because I established that rule after I had bought a lot of things like Microsoft and ASML and a couple other things. But now that I have that rule, it just means that I will filter that sector out of my watch list when I am getting ready to buy, so they don't distract me from other opportunities. There are a couple sectors that I'm really low weighted in, and energy is one. There it is. Let's restore everything back again. Energy is one. And I was looking earlier for a way to add energy that would still give me growth. And I literally cannot find any energy stock that has done well over the last 5 or 10 years. I was looking at even the ETF, the Vanguard Energy ETF. And if you look at the momentum of the exchange traded fund, which tracks the average of the entire sector, it's red all the way across the board. There is nothing that is attractive to me in this, not even the dividend yield. You know, it's a lot of the energy companies like ExxonMobil and Chevron, they pay a decent dividend yield. But what you are getting in dividends is not making up for the loss in value because their stock price is going down. And that's one of those, oh yeah, it'll give you a revenue stream, but we're not thinking in terms of periods of time. Right now, I'm in total growth. When I hit 65, it's going to transition to healthy income, because at that point, I want an income stream that can pay my bills. And anything that doesn't fit the strategy is going to get cut. I want as much as possible in my portfolio in balance when I hit that transition point, because I need to sell my growth stocks, buy my income stocks, so that I will have that income stream going forward. And if you think that a stock like this, which is based around current income, another one is AT&T, which we could talk about later, but AT&T is a good income stock, but it's not growing. And if you have more than 5 or 10 years in your timeline, it's not time to buy that, because it's not going to build you a portfolio that you can transition later. I want that portfolio to be as big as possible. And the only way to get that is with growth companies. Let's look at total growth on the ETF here. It's at, okay, 5 years, it's at negative 45%. 10 years, negative 18, but it still is a negative number. It's like, I'd go back in time to 2014 and sell out of energy and just buy the S&P, and you'd be much better off. So yeah, Nick, if you don't feel good about energy, look at the numbers, look at your rankings, and look at the criteria that you care the most about. And if something doesn't meet that criteria, ignore it, because it's not going to give you the return that you want. It's not going to help you reach your goals. Marcin. Excellent. Okay. Jaworski. Marcin is the guy who came up with the bullish list. So I'm really glad he's watching. That's awesome. Marcin, if you ever want to join one of these, you're more than welcome. All right, let's see. TPL gets a high score in every ranking I run. 101st place TGI. Okay. Yeah, it's energy, but it's not just energy. Let me bring up, without misspelling it, TPL. Texas Public Land Trust. So they are in the energy sector in stock markets because what they've been focused on for the last couple of decades is oil and gas. But TPL in particular is a really interesting stock because they're more like a REIT than an energy company. Okay, they actually own the land. Let's see. As of December 31st, 2019, it owned the surface estate in approximately 901,000 acres of land. 19 counties in the western part of Texas. This is what I want to draw your attention to, the water service and operations segment. Okay, they are getting into much more than just oil and gas. They are getting into water, and they also lease out their lands for farming and whatever else. Okay, it's not just oil. This is an extremely expensive company, 547, but if they can follow the electric car industry and move away from oil and gas and move towards renewable, move towards other things, then they can continue their revenue stream, and they are in the process of doing that infrastructure. They're also a very old company. 1888 is when they were launched. Ben, have you looked at this company at all?
I haven't, but it sounds very interesting. I was just looking at their dividend growth, and their dividend growth is pretty crazy for the last 2 years.
Yeah, it is.
Looks like they increased it by about 200% in 2018 and then another 66.7% in 2019, which would take the yield on cost quite a bit higher.
Yeah. Let's look at yield on cost. So this is just 5 years. So if you bought it back in 2015, you'd be getting 11%. Back 10 years, 60%, 20 years, 200%. And all Okay, this was a good time to buy in 1992. Um, we keep joking about time machines. Um, 536, 543, and it keeps going up. 563.68%. If you had bought this stock in November of 1992.
That's
Wow.
pretty amazing. I would have loved to have gotten that.
Wow. They probably got some stock splits in there as well. And yeah, they've boosted their dividend significantly just over the last couple of years.
Yeah,
So much so that the dividends between 1988 and 2004 don't even register on the scale.
that's pretty amazing. Yeah, it says that since 1992, the share price is up about 6,000%.
Their 10-year total growth, 2,091%.
Not bad.
So let's see. Let's look at some recent news on TPL. Um, to reorganize into a Delaware corporation. There's a dividend announcement. So they are doing a transition of their corporate structure, a reorganization to help focus on more than just oil and gas. This one was from October 23rd, 2019, greatly undervalued on a DCF basis. Ben, what is DCF again?
Discounted cash flow.
Discounted cash flow. Okay. They do have risk because of their focus on oil, and they know this. That's why they're doing a transition. If oil recovers, of course, they'll do really, really well. Um, yeah, I don't know. This it is an energy company, but they're also getting into other things, and they're not. I mean, that land is pretty high acreage, and they can do anything that they want with that land. Um, I mean, imagine if they put solar on a lot of that land and stayed in the energy sector, but actually, we were talking about this earlier, weren't we, Ben? A solar company transitioning in.
Mm-hmm.
I mean, British Petroleum, BP, is trying to rename themselves as Beyond Petroleum. Some of the biggest investors in renewable energy, solar panels, wind farms, tidal, geothermal, et cetera, are the energy companies because they want to be more than just oil.
Right. And oil doesn't have a lot of positive feelings associated with it right now in terms of consumers and just
Right.
public perception. So distancing from that's what a lot of companies are trying to do.
But at the same time, we have to recognize how much of our civilization is based around it. I mean, it's not just burning it for energy or burning it in our cars for transportation.
Mm-hmm.
Look around you and see how much plastic there is.
Yeah.
That's oil, and that's not going to
Plastic,
go away.
rubber, a lot of the rubber products that we use, has like oil that's being used to refine or process it. And yeah.
Yep. Another example is paints, and Sherman-Williams is really high on my list,
Mm-hmm.
on my TGI list, because they're doing really, really well as infrastructure comes in and gets built.
Mm-hmm.
So that's all the comments, and that's all the stuff that I've built here. I'm going to do a quick review. This is over the last 2 weeks. My Facebook page, Total Growth Investing, has grown 77 to 249. My YouTube channel is pretty substantial, a growth of 38 up to 172. My watch hours, people over the last 2 weeks have really liked my videos. I'm working on a comparison between Visa and MasterCard right now. I watched yours, and there was something missing that I'm going to try to fill in, and
Sounds
that is
good.
the history. Where did they come from? What is the landscape of the credit industry and things like that? And where are they going? You touched on that, on where they're going a little bit,
Mhm.
but with the advent of blockchain and other ways to reduce the cost of transactions, they are either going to cash in and really take advantage of the new market opportunities, or they're going to find themselves really struggling as a competitor with a faster and cheaper alternative comes along. And then there are companies that don't care about any of that. They're just going to capitalize on it anyway, like GPN, like Global Payments. They use Visa, MasterCard interchangeably along with American Express, Discover, UnionPay, and all of the others.
Mhm.
Um, and every single one of those companies is getting into blockchain and cryptocurrencies and the global systems that are coming online. So I want to fill that in a little bit. I also found it interesting. Last time I did this review, Oxford Lane Capital, my two videos, I did a live stream clip and a full stock review on it. They are my top favorites.
Hmm.
And I think it's because it's one of the only videos on YouTube that talks negatively about Oxford Lane. Everybody else is going, this is a fantastic stock
Mhm.
because of the dividend yield or something. No, it's not.
Well, it's good to have that alternative perspective. Gives more balance.
Right. Okay, it's been an hour. This was fun.
It was. And congratulations on all your growth. Speaking of total growth, congratulations on your social media growth.
Yeah. Well, I'm not focused on it as much because I've got a regular paycheck coming in and I don't have to worry about it that much. And I'm also, I don't know, I think I'm going to record the Visa MasterCard um, really soon
Mhm.
because I want to get it out there. But I have a new computer coming on Friday, next Friday, that is going to really help. Your videos are incredibly high quality. I'm really impressed with what you do, and I know that they are a lot of work to put together. Um, you and I should get on a private chat sometime so you can show me how you do that.
Okay.
I'm going to have my own style, but
Okay.
the computer that I have coming is going to help me do a lot of video editing and animations.
Mhm.
Um, and that's I want to put out quality. And right now I'm trying to put out quality content, but I also want it to look good. Um, and the reason why we're using StreamYard right now instead of OBS is because I tried OBS with a guest with
Mhm.
Torsten, um, and my computer crashed. Like I don't have a video card. I have an on motherboard video chip.
Yeah.
My new computer is going to have best of the best, and I'm looking forward to seeing what I can do with that.
Yeah. That upgrade will be amazing.
Okay, so we're going to sign off, and I'm going to be doing live streams, hopefully with the guests or just talking like I did on the daily every weekend at least. And I will continue to put out videos. Ben, how you put out a new video about every week, right?
That's right.
So let's see. So here's Ben's channel. Um, oh, really quick, I got my URL. Um, Total Growth Investing.
Very nice.
I found that out yesterday, and I
Looking
thought
very
that was cool.
professional.
And I caught it because, let's say, Ben and Andrew has that on his YouTube channel as well, but evidently, okay, on his channel, there we go, Andrew Brown. Well, he did, I thought, anyway. But I saw you had it, stock investing, investment analysis,
Mhm.
and now I've got total growth investing.
Awesome.
Um, we are rambling. We really need to cut this short. All right.
Well, thank you for
Good.
the invitation and for the opportunity. I really appreciate it. It
You
was fun
bet.
talking.
Looking forward to seeing what what videos are you working on right now?
My next two are going to be AbbVie and Bristol Myers Squibb.
Oh yes. Oh yes. Looking forward to those. We've talked about those in the past.
Yes,
They
we
have
have.
some huge potential coming
Yes,
up.
very much so.
All right. Okay, so thanks everybody for watching. Thank you for the comments and the discussion. This will be archived on the channel, and I'm also going to download it and throw it up on YouTube as a live stream. And like and subscribe to both of us on YouTube. And you have a Facebook page, right?
Not a investing
No,
page. No.
you don't. Okay. All right. Well, subscribe to Ben's YouTube channel and keep an eye out for the new videos coming on. And we will talk to you all later.
All right. Bye.